So it's recording. The discussion will be recorded and the link will be available after the meeting. If you have questions, please type them in so I can read them out loud when the session of question and answer will be open. Okay? Thank you. I'll pass the floor to Daniel Gros.
Okay, thanks a lot, everybody. And I presume we have here a group online which knows about the country and is following the events. And all I wanted to do is to give some perhaps more general background, which then Stefano can complement and hopefully update with his insights of the political situation and how it might be evolving. We already had a webinar earlier this year where I talked about reasons for low growth. I won't go into that right now. I was just trying to advance my, let me see whether I can, how do I advance it?
Oh, no.
Okay. So I just wanted to ask, what is new in a certain sense? What has come up over the summer and over the last days? And the first part is, of course, doubt about debt sustainability, related also to higher interest rates, and then doubts about the commitment to the euro, which we saw again in the reaction of the markets to some pronouncement by what is after all a second-rate figure in the Lega movement. And also let me just say something which I presume many people you know, but it's still important to keep in mind. When we're talking about debt in the case of Italy, it's not debt of the country or foreign debt, but it's government debt. There's very large private sector assets. There's little net foreign debt. But we also know that the government bonds held abroad, plus the target 2 balances, they're worth around 800 billion or almost 40% of GDP. They are counterbalanced in the net foreign asset position by private sector assets of approximately the same size. And that for those who want to be, how to say, frugal, want to be too clever by half, that creates the incentive for a selective default a la Savona, to which I might come back later. That is actually something which is discussed very intensively in Germany. I'm part of a group of, let's say, a large number of German economists. And in that group, we have exchanged literally hundreds of emails this summer about what happens if Italy exits and defaults on target, what the losses would be for Germany, what the incentives are, and so on. So this is, as I said, under the political visibility level, it's very much a concern in Germany. Let me come back to the first part, which is doubts about debt sustainability in the classical sense fiscal. Now, just to show you at the beginning, this is actually what the Commission does in its so-called debt sustainability assessment. It says with certain probability, this happens, that happens, interest rates go up, other things go down, and certain shocks can materialize. And what you see is that in the end, they come to the conclusion that there might be a small decline, but there's a very high degree of uncertainty around it. Under unfavorable conditions, that can actually increase. I will come in a minute to the issue of where that could happen. Now, if you look actually at debt sustainability and keep in mind that all this outlook is very uncertain, then ultimately it's a problem of the willingness to pay rather than the ability to pay. So it's ultimately a political problem, a political problem in Italy, in the country concerned, whether you can just get together enough taxes to pay out interests, which is mainly to your own people. And we all know that the key parameters in this equation, in the question whether the debt burden will increase over time are the interest rate and the growth rate. And if you look at that, it actually doesn't look too bad, because most people would assume that Italy can look forward to a growth rate of nominal GDP of approximately 3% in the long run. 1 to 1.5% growth, real growth, about 2% inflation, give or take a little bit around 3%. Remember the uncertainty which I showed earlier. This is always to be taken with a certain range around them. And the key issue then is, will interest rates be higher or lower? And until very recently, the answer was easy. Italian government debt was actually trading for 10 years at 2%. And the average cost of debt for Italy was, until May this year, only less than 1%, because it has a very high credibility, and the short-term part of the debt was trading actually at negative rates. So the average overall cost of new debt issued by the Italian Republic in 2017 was 0.68%, much less than the growth rate of nominal GDP. So in that case, sustainability seemed not much of a problem. Of course, no longer today, because today we have interest rates also around 3%. A little bit more, a bit less, as I said, growth rate 3%, a little bit less, a little more. This is the area where we are talking about, and therefore we are sort of at a knife edge situation for the country, and the risk premium is becoming a life or death issue. And we see that the government is actually reacting to it. Now, and I see two reasons for this risk premium. The pure fiscal one, I will come back to that. And then, of course, the political one, which is the Ital exit question. Now, the fiscal reason on the risk premium is, it's interesting, actually, because if you look at the so-called DSA, Debt Sustainability Assessment, of the IMF, of the Commission, of other people, what you find is that the key question going forward is that the risk premium is a function of the debt level. And that creates a self-reinforcing feedback loop. You have a high debt level, you pay a high risk premium, you have a higher interest rate burden, because high risk premium times high interest rate means lots of expenditure on interest, and that then pushes the debt level even higher. So that is why the situation would become quickly unstable when you have this feedback operating. As I said, until May it was not operating because the Italian government had achieved a certain credibility, and that's no longer the case. For those who are more numerical, I give you what the Commission assumes. The Commission assumes that the interest rate is equal to the riskless rate, which is now around 0 for Germany, plus 50 basis points, plus 0.03 times the debt ratio in excess of the 60% threshold. This threshold actually comes out from empirical studies as well. It's not just the Maastricht Treaty thing, but it comes out. And that would mean that the risk premium for Italy would be today around 210 basis points. It's actually a bit higher, but these models would say is actually, this is what Italy has to count on. And of course, if the debt level were to increase, it would go up. And on the other way around, as I said earlier, if the debt was on a credible downward path, then the risk premium would go down and would have a self-reinforcing loop. So that's the fiscal part, which shows that really, once you're at 130%, you're getting into an area where you can go off either to infinity, or if you make a little bit of effort, then you can go down towards a safer region. Now, on the political reasons for the risk premium, I've talked the last time about the so-called Savona plan. We have had the two presidents of the Economic Committee, both in the Senate and in the Camera. They're both people who have in the past said, we think Italy would be better off with its own currency. And they've actually repeated that over the last days. Then saying, oh, okay, yeah, but by the way, it's not in the program of this government, right? But showing that there are certain political forces which are thinking about this. And then, of course, that has one implication, that the finance minister can do only so much in limiting the risk premium, because there's the fiscal part and there's the political part we want to get out. How do you measure these two parts? And here I just wanted to refer briefly to some work which I have done over the summer. Two ways you can look at, let me take the second one first. There are two CDSs, CDS base 2003, which covers you only against the fiscal risk. And then after 2011-12, when it became apparent that there was also denomination risk, in 2014, the CDS documentation was changed so that now it also protects you against a redenomination risk. And therefore, the CDS 2014 base cost more than 2003. A similar thing you can look at if you look at the risk spreads on US dollar and euro denominated bonds, and both give you a similar picture. Here I have given you on the horizontal axis the CDS spread 2014, on the vertical one the 2003. Horizontal is full protection against fiscal and denomination risk, and a vertical axis only fiscal risk. And you see that the slope of the line is about 0.5. So that means about one half of every increase in the risk premium of Italy is due to denomination risk, which leaves another half, of course, to the fiscal side. The precise mixture can, of course, change from week to week, and I haven't looked at the very recent data, but as a rule of thumb, I would say both elements are important for Italy. You get a similar thing if you look at US dollar denominated bonds or euro denominated bonds. The risk premium on euro denominated bonds is much higher than on dollar denominated bonds. Okay, so that just confirms that. Now, where does it leave us? Looking backwards, I would say Italy had a golden opportunity basically to be on a self-reinforcing path towards fiscal sustainability. The debt cost was very low, and the government didn't really need to do anything. Or if it had done nothing, things would have improved automatically. And now we are basically back to the brink for both fiscal reasons, the highest deficit now planned, and for the political reasons which I mentioned earlier. And that is basically my message. And perhaps now I hand over to you, Stefano.
Thank you. Where to start? First, we still don't have the full document from the government detailing what they intend to do. We have this number, 2.4% deficit to GDP ratio, and we see that there is now a very strong strain between the two government main shareholders, Lega and Movimento 5 Stelle, on who gets what. Because the total number they have at their disposal, which is about 16 billion maybe, under the hypothesis that they remain within the 2.4 deficit limit, and taking into account some revenues that would be one-off, that would apply only to 2019. But this number, 16 or 17 maybe billion, or we don't know exactly, is not enough to satisfy the demands by Movimento 5 Stelle to introduce the basic income, which they call citizenship income, the citizenship pension, plus some money for strengthening the public employment offices to verify the conditions for access to basic income. And on the other side, you have a demand by La Lega basically to open the doors immediately to about 400,000 new people to go into retirement, advanced retirement, only with the famous quota 100, level 100, which is the sum between the retirement age and the contribution, the number of years that contributions were paid for. Because the resources are visibly not enough, they are now studying, apparently, from what we know, measures to reduce the disbursements under each of these programs. For instance, they are thinking about the possibility of putting a limit of 38 years in contributions paid, or they are introducing tighter or stricter conditions for access to the basic income. Including the fact that if you own a house, you get less and things like that.
Stefano, can I interrupt you? You should go a bit further from the camera.
Yes.
Otherwise, we see only your hair.
So the first thing is that, okay, now it looks better. The first thing is that we don't know the measures, but the numbers are very scary, are rather scary. The second thing is that this new budget is apparently being drawn under growth hypotheses that are not credible. They are telling a story of huge investment program, but the numbers they show are small, that are, in their view, would raise growth from the current consensus forecast of less than 1% to 1.5%. This is today's new number. Yesterday it was 1.6%. And the 1.7% of 2020 has also been reduced to 1.6%. It's very hard to see how this can happen, especially because what we see now is a distinct slowdown in economic activity. Many people think that maybe GDP will be flat in the third and the fourth quarter. If this is the case, you would need a rate of increase between 0.5 and 0.6 per quarter to achieve that 1.5 growth in 2019. So this is hardly credible, and especially in view of the adverse impact of rising interest rates, and more important, of heightened uncertainty on investment and credit.
Stefano, can I interrupt you? Just a question. We're always talking about the growth assumptions for 2019 and then what resulting deficit. Are there any indications what actually the deficit for this year, 2018, is likely to be?
The number, it's about 2%.
Okay, thanks.
What the truth of the matter, it will be about 2%. So actually, you can see that if you go from 2 to 2.4% between 2018 and 2019, there isn't much of a net impulse on demand, incidentally. This is what we know about the current plans. Of course, now the government has announced that they are ready to reduce the deficit for 2020 and 2021. But the Commission has made it clear that the respect of the Stability Pact will be assessed, first of all, on the number for 2019, which they intend to keep at 2.4% of GDP. Now, 2.4% of GDP is a worsening of the structural MTO, the medium-term structural deficit, of almost 1 percentage point. And the Commission was expecting an improvement by 0.6% of GDP. So we are talking here of an overrun of 1.5% of GDP, which makes it, in my view, impossible for the Commission not to open a procedure. A procedure which, for certain reasons, will be an excessive deficit procedure. The reason is that the Commission had in a way subsumed the respect of the debt rule under the respect of the medium-term objective rule. The first one is in the corrective arm, the second is in the preventive arm of the Stability Pact. With the result that if we violate the medium-term objective, we are also violating the debt rule, significant reduction towards the target of 60%. And so we will find ourselves automatically within the excessive deficit procedure. Which brings me to a further important point in understanding what's going on. In many ways, the situation looks less bad than in 2011 because we have a current account surplus in the balance of payments, because net foreign debt is negligible. I don't think it's appropriate to count target balances as running debt in the market, because it isn't. It is not something that responds to market pressures. So the exposure of the government to the foreign sector is probably about 300 billion or 350 billion, which is not a large number. Of course, it is not irrelevant, but much of the Italian debt is held by banks and insurances, more than half. And then, of course, the ECB now has some 20%, and the public has about domestic, some 15%. If you look at the number of indebtedness and what I said about our net position, so you get the feeling that Italy is less exposed than in 2011. However, the financial situation remains very fragile because of large holdings of debt, public debt, by the banks and by insurances. About 40% of total assets of the insurance sectors are government debt, which of course brings nice returns. And the debt of 10% of the asset side of our banks is represented by government bonds. Now, the problem with these holdings is that under the new accounting rules, if there are losses in their capital value, you have to register them rather rapidly in your profit and loss accounts. So as soon, when the spread moves, you immediately see share prices of the banks falling. The spread above 300% is also perceived as a good forecast of the likelihood of a downgrade by the rating agencies. So you are now in a situation in which the rating agencies are becoming rather nervous about the sustainability of our debt. and the sustainability of the public finance plans of this majority. A downgrade is becoming increasingly likely in October at the latest, when the Commission announces the start of a procedure. If you do this, you can expect a further fall in bank share prices and a further need for capital. The spread eats in the capital of the banks because of the accounting rule that I was mentioning. So while the general situation is less weak than in 2011, the doom loop channel and the likelihood of this being aggravated by a downgrading by the rating agencies, here you have an element of distinct fragility that may become the main game in town if the government doesn't manage to reassure investors. So this is, I think, where we are. It is not clear yet that the majority wants to go for a straight challenge of the European limit of 3%. I am not sure they have fully understood that an excessive deficit procedure will start anyway, even with the 2.4 announcement of the deficit. But so far, the two parties in government are still trying to find a way to meet their electoral promises without further breaches in the European constraints. But the numbers that they have are inconsistent with European rules. Their hope that they can negotiate an exemption is not well-founded. So the question still remains, will they break the limit by stealth or after the budget is approved? Or will Parliament raise the limit because there are very high demands to satisfy these demands for redistribution? And I think here you remain with a lot of uncertainty. My hunch is that if the tension in financial markets grows further, they will back down. So I tend to think that they don't want to go for broke now. If they have to go back, however, the survival of the government comes under fire. It's unclear that if they cannot satisfy, at least in their view, what is decent distribution of money, if they have to back down because financial markets are closing the doors, it is unclear to me that the government can survive for very long. So then you wonder whether there will be earlier election, which is what Antonio Di Maio keeps on threatening. He says if we don't get this money, then government crisis. So this is where we are, trying to look at the crystal ball and understand what's going to happen.
Thanks a lot, Stefano. We have opened already for people to ask their questions, and so if you have one, you have to type it, please. Stefano, I wanted to give you already the first question which we have, which is, how do you evaluate risks that Italy's fiscal issues would affect Italian banks, which are big holders of Italian government bonds, or would eventually affect the global or European financial markets?
Well, as I say, the banks are highly exposed to developments in the spread and the risk premium. So, and this is a distinct element of fragility. On the repercussions on of a deepening crisis on the financial situation of the rest of Europe, I'm unclear. I know that investors have been getting out. The net positions of foreign banks vis-à-vis Italy have been reduced significantly. So if I look at the sheer numbers, I would say that foreigners have been reducing their exposure to Italy. I don't think this is enough to say that if there is a deep crisis in Italy, nothing happens outside. But certainly the repercussions would be less important than we observed potentially in 2011.
If I can add to that, I wanted to say that as you said, in 2010-11, these positions were larger, but also they were held by people who had these positions when they thought Italy is riskless. Anybody who has still an open position on Italy has been warned now for years, right? So it would hit people who presumably have made also provisions for some of the risk to materialize. And let me add a second point, which is, actually I don't know which way it goes, which is that the Italian banks are now supervised by the SSM, an arm of the ECB. And this is why now the Italian banks are between a rock and a hard place. The SSM tells them not to concentrate their risk, and the Italian authorities call them, asking them to buy government bonds. So the banks are, let's say, at least in a different position in 2010, 11, and 12. In the sense that 2011-12, there was only one pressure, buy to save Italy. And now there's also the other pressure is don't put all your eggs in one basket, and you have to recognize the risk in the market price.
If you permit me an observation, we have not seen explicit demands by the government to the banks to buy government bonds. But we have seen a return of purchases by the banks basically since the election, since the 4th of March election results. Why are the banks buying these bonds? A good question. Probably the idea is that if the government goes back to its right senses, bridging the positions in view of possible improvement is not an unreasonable strategy. The thing that has been very heavy on the banks is the behavior of their share price. Basically, the share prices of the largest bank have fallen between 35 and 45% since the elections. And this is in a situation in which capital is much stronger, disposal of NPLs has accelerated significantly with really large numbers going away from their balance sheets, and profitability has been increasing remarkably. The behavior of the share prices is clearly driven by redenomination risk. I see no other explanation. It is imperative that the government abandons its current course to halt this. Otherwise, I think we could very well be navigating the doom loop, the famous doom loop again, between government bond crisis and banking crisis.
Stefano, if you permit me, there was a second question which was addressed to me, but maybe you would also want to comment, which is US yields are on the rise. How do you assess their impact on Italian yields as a source of risk? Now, in the past, I would have said I would expect European and US yields to be highly correlated. And therefore, if there were to be an increase in European yields or Euro yields, that would certainly be a more difficult situation for Italy. As I said earlier, right? Low growth, high interest rates, that's deadly. But I don't see that. I see the Euro area interest rates staying low for much longer because inflation is so stubbornly low. There's, of course, the other part, which is that we know that from the work of Ray, that the interest rate of the US determines the financial cycle globally and the risk appetite. So there could be an indirect impact of reduced risk appetite globally, financial cycle turning down, which then hits always the weakest element everywhere, and that would also have an impact on Italy. I don't see that happening to a very large extent. So I would say increasing US yields, in my view, will be a sideshow. They will be much more important for emerging markets than for Italy. But maybe
for this year, I would subscribe to this conclusion. As inflation comes back, the normalization of rates in 2019 after mid-year may contribute to the pressure. But I agree with you. The main factor now is the idiosyncratic risk on Italy. Keep in mind that the 10-year BTP yield yesterday was above 3.3%, also thanks to some increase in the German Bund rate. There is one thing that I want to mention. The government bonds that are expiring at present are, in broadly speaking, carrying fairly high interest rates. As a consequence, you will still see the interest rate burden on government debt going down as this debt matures and is renewed. So we will not see a large impact of the increase in interest rates on the debt service for the coming year. And again, so expectations play a larger role than actual numbers, it looks.
And as you know, I presume people on the call are very well versed in financial markets. What is worrying is that at present, also the 2-year rates are pretty high at, I think, 160 basis points yesterday. And that compared to a German yield of minus 40-50 makes a 200 basis points risk premium even over a 2-year horizon. And that is that is a considerable flattening of the risk yield curve, so to speak, which, as we know from the past, is always very worrying. And that's also the reason why the average cost of new public debt in Italy has actually increased. I would be less optimistic than Stefano. I think we are already at the point where the marginal cost of new debt is approximately equal to the high interest rate old debt which is being retired, so that the interest burden will no longer fall. Stefano, your presentation earlier suggested a couple of questions to me. First, let me just make two now. First of all, this magic number 2.4, how did it fall out of the sky? did it result from saying we want to do this and that, and the cost is 2.4%? Or did they first say, okay, we take 2.4%, and then we see what we can do within that constraint? And the second point, which was a bit surprising, I thought in this coalition, the M5 movement would be the big spenders, and the Lega would be more responsible. And you seem to suggest that on pensions, actually Lega is more, say, more irresponsible.
What, starting from the last question, they seem to be competing in irresponsibility with daily announcement. So the climate is a climate of full electoral campaign. And whenever one of the two bosses says something, the other one doubles down. You have to, they seem to think that they fight every day to an extent for the same electorate. So Salvini says 400,000 new retirements, and Di Maio says citizenship pension, which would have raising the minimum pension to 780 euros, which would have a devastating impact on the sustainability of the pension system. For the time being, you see two parties equally extreme in their position. They want money to distribute no matter what. They are concerned about financial repercussions, but they think there is still room to play the game. There is a thesis around, I don't think very well founded, whereby financial markets will be satisfied to obtain higher interest rates from the Italian government, but they are not ready to kill their debtor. A sort of rational behavior by people in financial markets wanting to make their money. In an atomistic investor environment, it is more likely that many players will decide to run for the door rather than waiting to see whether the debtor will be able to pay. On the first question, how did they get this number? I think they thought that 2.4 would be the number and the 1.6% growth rate, the two numbers that could be used together to argue that the debt to GDP ratio would diminish. The reason the 2.4 was also including a message that they were not going for broke relative to the 3% deficit limit for the excessive deficit procedure. At the same time, the decision to break the 2% limit, which everybody thought in the end the Commission would accept somehow, even if in straight violation of current rules. Unfortunately, the triggering factor was the announcement by the French president that the next budget would carry a deficit number of 2.8%. And politically, this was devastating. Forget for a minute the fact that once you look at the numbers, we know that France is actually reducing the structural deficit considerably, and of course has a debt to GDP ratio much lower than others, below 100% of GDP. But this, in the political debate, became irrelevant. The big cry was, we are a sovereign state, you know, they let France do things that they don't let us do. And politically, this was a disaster, because this is what pushed the two parties in a way to break the dike go for a larger number. As I say, they chose 2.4, in my view, as a signal still to investors and the Commission that they do not want to go straight for a break of the 3% limit. Of course, 2.4%, if the growth rate expected does not materialize, will mean that you'll find yourself rather quickly close to the 3% limit at all events.
Thank you. Just as the last call to the other participants, if you have a question, please type it now. Otherwise, I have one last very specific question to Stefano. If I remember correctly, under the fiscal compact, any country can also go to the Court of Justice for the breach of the deficit rules or the debt rules by another country. Theoretically, that could happen now, could it not?
It's a rather impervious way to constraining the Italian government. We shall see. At all events, any such procedure would be slow. There are also people in Italy who think that the current, the budget in preparation, which we have not yet seen, nobody has seen, may be violating Italy's constitution, and therefore may lead initially to its rejection by the President of the Republic. This I don't know, I'm not a constitutionalist. We will just wait and see.
And the fiscal, what's it called? The Ufficio Parlamentare del Bilancio, the fiscal watchdog.
The fiscal watchdog, I think, will create problems for the government because it is independent. They have strengthened their behavior, and they, I think, they were rather critical already with some of the projections produced by the Renzi government and the Gentiloni government. So I don't think, you may expect the Ufficio Parlamentare di Bilancio to raise questions.
Okay, there's a last question, which is, how do you see immigration issues in Italy now that Lega supporting rates are increasing?
Well, it has been for some time now, it has become a big communication context. Our problem is no longer with the flow of new immigrants. Our problem is that we are not doing anything, not enough, we are not doing anything to handle the probably 300,000 above immigrants in irregular position which are in Italy. We keep them in compounds, but there is very little training. Locally, something is happening, but the government policy is to declare them non-existent. And all support, the budget money available is being removed from the budget chapters that could help integrate these people. The integration policy today is a curse. So this is the real problem. The real problem is that if you keep large numbers of people, we are not letting them work, we are not training them, we are not integrating them. So this becomes a mass of destitutes walking around in the gardens and the stations, the railway stations of the cities, and fueling the Salvini propaganda. So here there is a risk of a vicious circle. Government policies trying to hide denying their existence and not helping integrate them leading to further claims that immigration is a danger and is disrupting our social life and so on.
Thanks. I can't resist but making this remark that the German government has just done, if you want, the opposite. They have recently passed a law under which asylum seekers whose claim has been rejected can still remain indefinitely in Germany as long as they have a job and are well integrated. So that's, and even the populist Seehofer has agreed to that.
Yeah.
Okay. I have two further questions here. One is on the ECB's QE policy, which I will take if you don't mind, Stefano. And then one is whether an increase in VAT would make sense. And Stefano, while you're preparing your answer, if you don't mind, I say a few words about the QE of the ECB.
You want me to answer first on the VAT?
Why don't you answer first on the VAT? Yeah.
Yes. I think it would be a very good idea to let the VAT increase, and this would create real room for lowering taxation on labor and enterprises. For some reason, all the politicians of all parties have been strongly opposed to this, and I think this is a disaster. It's completely wrong.
You could have a fiscal devaluation, right?
Exactly. It would be a fiscal devaluation. It would provide relief for the very high labor cost that we create the room to provide relief for the very high labor cost that still plagues this country. And in addition, if you look at the latest projections for the Italian economy produced by the Paduan and the previous government, it would help inflation, with the result, well, there would be a step increase in the level, in the price level at least, but probably also some small increase in inflation, with the result that the sustainability of the public debt would become easier.
But of course, you have a very large VAT gap, so it's not quite sure how much money you would get. Eh?
Well, that's a different question, but still, 12, they are talking, the famous safeguard clause is about 12, 13 billion. So it's almost 1 percentage point of GDP, even if we have a large tax gap, which is correct, but there would be some effect on prices. Also, the message could be interesting, but of course the shopkeepers would hate it, and they are an important part of the electoral basis of La Liga.
Okay, so let me just take the question on the QE of the ECB. I'm on record as saying that this has zero impact on the Italian risk spread. The first line of answer is, of course, that it is not the ECB which is buying Italian BTPs, it's the Banca d'Italia. And the Banca d'Italia does so at its own risk, and the Banca d'Italia is part of the Italian government. So that's why this buying of government bonds by one arm of the Italian government from the other doesn't really change anything. The second point is, if you are a private investor and you think about the risk that you have if Italy becomes insolvent, if a substantial part of the outstanding debt, or the outstanding bonds rather, are held by the Banca d'Italia, that's a part which cannot be haircut further. Cannot be haircut, full stop. That means that the remaining private sector holders of government bonds, Italian government bonds, must expect a higher loss should the Italian government default. So the loss given default would be probably higher now that QE has led to a large stock of government debt on the Banca d'Italia's balance sheet. Whether the probability of default falls is a different matter, because you could argue, and Stefano has done so earlier, that the liabilities of the Banca d'Italia are target balances and some commercial bank deposits. And on these liabilities, the interest rate is fixed, and therefore you don't run a risk of a run, right? So you could argue that the fact that the Banca d'Italia sits on all these government bonds increases the loss given default, but maybe reduces the probability of a default. What will happen to the product between the two? We don't know. And the second point is actually, if you look at the empirical evidence, you see that when the QE started buying its program, not the Banca d'Italia, but when the QE program started and the National Central Bank started buying government bonds, Italian spreads first dipped for a couple of weeks, but then immediately rose up again. So there was initially, in my view, a very temporary impact of the QE program on the Italian risk spreads, but it disappeared very quickly. And therefore, I would think the fact that the QE program now ends towards the end of this year probably has little impact on Italian risk spreads.
Except because of a possible expectation channel, of course.
Yeah. Okay, I think we have come to the end of it. Let me just say, and maybe Stefano, you will agree with that. My view is that the Italian government, and let's say the wider Italian political system, has a tendency to go towards the brink. They just go as far as they can in spending until there comes a strong, not pushback, a strong reaction from financial markets. Then they stop just short of a catastrophe. Things go a little bit better. Then after a while, they go back. So unfortunately, my view would be that the country is likely to stay in this precarious situation for quite some time. Stefano, over to you. Stefano, over to you.
Let's hope not.
Okay. Thanks a lot, everybody. Have a nice rest of the day. Bye-bye.
Bye.
Have a nice day. Bye-bye.
Grazie, Stefano.